Welcome to RP Data's update on housing market conditions for June 2014. Last month we saw dwelling values fall by 1.9%, the first month-on-month fall in a year. The fall in dwelling values is partly seasonal, but can probably also signify a change in housing market conditions towards a more sustainable level of growth going forward. The month of May saw dwelling values across Australia's capital cities fall for the first time in 12 months. Values were down 1.9% in May, following on from a relatively soft 0.3% increase in April. The weak conditions were broad-based, with all the major capitals recording a decline over the month. Part of the weak index reading can be attributed to seasonality. Values have fallen in May over the past 3 years as the market rebalances from what is often a stronger first quarter. Seasonally adjusting the index still provides for a 1.2% month-on-month decline in May though, so it's likely the recent slump in growth is more than just a seasonal phenomenon. The rolling quarterly rate of growth has been slowing across the combined capital city index since August last year, suggesting the market has likely moved through the peak of the growth cycle. It's rare for a cycle of growth to last more than 2 years across the Australian housing market. Natural barriers such as affordability constraints tend to slow market conditions down, as well as the fact that rents have been substantially outpaced by value growth, which has compressed rental yields in some cities. Other metrics from RP Data are also hinting that the market is starting to taper. Auction clearance rates have been trending lower since late February, when the weighted average capital city clearance rate hit 76%. Over the last week of May, the combined capital city clearance rate was recorded at 66%. Average selling time appears to have steadied at historically low levels, with the typical number of days it takes to sell a capital city home showing a subtle rise from 36 days to 37 days in April. Additionally, the average level of vendor discounting has edged higher in April, rising from 5.4% to 5.6%. Another important indicator is consumer sentiment, which has been easing since September last year. Consumer confidence levels and housing demand are closely correlated. The Westpac Melbourne Institute Index is down 16% since that time, and the index tumbled almost 7% in May in response to the federal budget announcement. If we see sentiment levels remaining low, it's likely to result in lower buying demand across the housing market. Let's have a look at the housing market conditions across each of the capital cities. Sydney's housing market has been an absolute powerhouse of growth over the past 2 years. Dwelling values are up 21% since the commencement of the growth cycle back in June 2012, with values rising by almost 17% over the past 12 months alone. The substantial rise in dwelling values has pushed the local median house price to $800,000, which is likely to be creating a formidable affordability barrier for a large portion of the prospective buyer market. Over the past 5 years, Sydney dwelling values have risen by 32.5%, while rents are up a much lower 25.7%. The result has been an ongoing fall in rental yields from 4.2% 5 years ago to 4.0% gross in May for the typical Sydney dwelling. Melbourne was the only city to record a drop in values over the 3 months ending May, with values down 1.9% over the rolling quarter. Melbourne's growth run has been impressive, with capital gains outperforming the capital city average over most of the past 3 growth cycles. New housing supply has been much more sufficient flowing into the Melbourne marketplace, which may be one of the reasons for the weaker capital gains recently. Additionally, Melbourne continues to show the lowest rental yields of any capital city, with a typical house returning a gross yield of 3.4% and apartments showing an average 4.4% gross yield. Brisbane's housing market is one of the few to record an improvement in the rolling quarterly rate of growth, despite values moving 1.7% lower over the month of May. Over the past 3 months, Brisbane values are up 2.2%, which is on par with the Sydney market. The Brisbane market's been an underperformer since the onset of the GFC back in 2008. However, with values rising substantially in the other major capital cities, a substantial price gap has opened up in Brisbane, where the median dwelling price of Sydney is now 52% higher than Brisbane's, and Melbourne's median dwelling price is 24% higher. This substantial value proposition, as well as a much healthier ratio of housing prices to rents, is likely to attract higher levels of housing demand to Brisbane going forward. Adelaide's housing market seems to be quite resilient to the fallout across the manufacturing and mining sector locally. The Adelaide market recorded a fall in May, like most other capital cities. However, values are up 1.6% over the past 3 months, and dwelling values are close to staging a nominal recovery, just 1% lower than the previous peak, which was back in September 2010. Transaction numbers over the March quarter were up almost 11% compared with the same period in 2013, suggesting demand is continuing to improve across Adelaide. The Perth housing market is continuing to simmer down after growth rates and transaction numbers peaked last year. Dwelling values were flat in Perth over the rolling quarter ending May, and the annual pace of growth has fallen from a recent peak of 9.9% in December last year to 5.7% over the year ending May 2014. Perth rental markets have also hit a wall, with house rents down 1.1% over the past year and unit rents remaining flat. Hobart's recovery run took a pause in May after values had been rising consistently over the previous 5 months. Economic conditions remain relatively weak in Tasmania. However, the sheer affordability of housing and above-average rental yields seem to be driving a modest trend towards higher housing values across the Hobart market. Darwin's housing market appears to be having a second wind after growth rates fell away during 2013. Darwin dwelling values have moved 5% higher over the first 5 months of the year, and although the market remains about 3.1% lower than when values previously peaked back in August 2010. Rental yields in Darwin remain the highest of any capital city, which may be one of the key market drivers. The Canberra housing market held virtually steady in May, with a 0.1% rise in dwelling values over the month. The national capital has posted a paltry 2.6% increase in dwelling values over the past 12 months, and growth prospects are likely to be muted by further job cuts across the federal government. Rental conditions have weakened substantially across Canberra, particularly in the apartment market, which has resulted in lower rental yields, although gross yields remain higher than the capital city average in Canberra. The decline in dwelling values over the month of May is likely to be more than just a seasonal slowdown. We'll need to see a few more months of data before this can be confirmed. However, a typical growth cycle across Australia rarely lasts more than 2 years. The current cycle is spot on 2 years in progress. In all likelihood, the housing market is moving through the peak of the growth phase now, and we should expect more moderate rates of capital gain over the second half of 2014. This doesn't mean values will continue to fall. In fact, I'd be quite surprised if that was the case, at least at a macro level. What's more likely is that growth rates will return to more sustainable levels, giving incomes and rents time to catch up. Based on the latest comments from the Reserve Bank Governor after the June board meeting, it looks like the low interest rate setting is likely to stay for the foreseeable future. The implied yield curve from the ASX cash rate futures market indicates that financial markets are pushing the odds of a next cash rate rise out to November 2015, which is substantially later than what was indicated by the yield curve a month ago. Low interest rates will continue to have a stimulatory effect on housing markets. However, some balance to housing demand will be found in affordability constraints and low rental yields in the largest capital cities. With some of the heat now potentially coming out of the housing market, it becomes all the more important for prospective buyers to undertake their due diligence, consult with financial experts and research their options before making a purchase decision. Once again, thanks for tuning into RP Data's Housing Market Update. For more information, tune into our mid-month market update. Additionally, you can visit our research blog and other housing market statistics at www.rpdata.com.